It's Louise Bedford here, your host of the Talking Trading Show. I'm so excited that you're here with us today. You see, as a best-selling author, I meet all sorts of people, and I really love it when people are brave and they show conviction. And I'm about to introduce a very special guest in just a moment. He has been incredibly brave and courageous to come onto the show, and you'll find out why in just a second. Look, just to give you background about the show, I always aim to show you what, when and where to trade. The focus is definitely on you as the trader. We talk about trading psychology, specific techniques and strategies to help you excel in the markets. But in all honesty, I have never ever done this particular technique live. So you are going to love it. You are in for a treat. Let me introduce our guest today. I am very excited to introduce Reggie Johnson. Not only did Reggie used to have his own radio show, he also runs 2 podcasts, Reg in ATL and a sports show called Just the Stats with his co-host Eugene Morton. Reggie is a new trader. He's been trading since 2020. Now, for those of you that aren't familiar with remembering those memories, with remembering the nerves that go along with being a new trader, cast your mind back if you're an experienced trader. You know, we would never start a multi-million-dollar business without a solid trading plan. We would definitely stack the odds of probability in our favor. And that is what Reggie has done. And he's very willingly and bravely and courageously decided, so that I can actually help him, to do a live trading plan review on Talking Trading. Reggie, welcome to the show.
Thank you. It's amazing having you be here. I'm very, very happy for this. Very excited for this trading plan situation here, you know?
Oh, what a willing victim. I love it. Oh, no, I didn't say that, did I? All right, so I'm going to just quickly refresh everybody's memory about what a trading plan is. Now, a trading plan is your overall business plan, how to approach the markets. The important thing with the trading plan as well is it wraps around your trading system. Your trading system is entry, exit, and position sizing. And your trading plan might cover things like what should you do when you go on holidays. So you can see that the two are actually interlaced. And also you can pick up my trading plan template from tradinggame.com.au. And this is exactly what we're going to use to go through Reggie's plan. So Reggie, are you ready, my friend?
I am ready. I am ready.
Good. Now, I've popped Reggie's plan in the show notes so everybody can see the raw essence of what he's conveying. But Reggie, can you take us through, first of all, what are your objectives as a trader?
A little more financial flexibility in my life. I like having something that generates income and capital that's not directly related to trading hours for money, you know?
Yeah, I think that's such a key because so often our bodies are the things that tend to break down. I know for me, I had a corporate career and I had to leave my job, and thank goodness I had trading on the side. Now, I want to set you up with the best chances for success. So can we have a bit of an emotional contract here, Reggie? Everything I'm doing here is for your own good. It is for the good of the people listening to the show. Nothing is going to be taken personally, I know. Please do take everything I say with that intent. I am looking to do my best for you. So even though sometimes it can be hard to be told that your baby is ugly, can you please know that I'm going to help you polish that diamond so that it really shines and that it really gives you what you want to get those objectives. I mean, that's the real key. So let's dive on in there with the trading system part of your plan. This is really where we're going to add some finesse, shall we say, to your plan. Can you described to everybody listening and with me as well, refresh my memory. What are your entry, exit, and position sizing methods?
I can't really say that I have a very fleshed out method. That's probably why the baby is so ugly as it is here now. But I would usually, when I'm making a decision on whether I'm going to purchase something, it's based on not necessarily the size of what I'm going to purchase. It's based usually on what kind of news is coming out about the company that I may or may not like. Do I feel like a company's being unfairly punished in the market for maybe an executive or the C-suite change, or maybe a product launch that didn't go quite as planned? So when I see things like that and I feel like a company's being overly punished and I feel like I can get it at a decent value, because I tend to try to buy on when a stock is down is usually when I'm headed in there. So that's usually my strategy, but I don't, Louise, have a specific like number I'm usually thinking about when I'm doing that. I might have a certain amount of capital that I want to go in with, but it's not a certain number of shares or anything like that.
Okay, so this is probably the biggest area we need to focus on because I'd really like you to become very specific with what you're doing. One of the things with the trading plan is it should be, if we hand over our plan to another trader, that they can trade it in exactly the same way and get exactly the same results. That duplication is so important. So I want to introduce a term to you. It's called archetype. Are you familiar with archetypes in terms of trading?
I am not. So I'm
No.
gonna write it down. I'm gonna take notes here as you're going. Like I
Yeah,
have my
take
notepad and I'm taking all
notes.
these notes. Okay, archetype. Okay, got you.
Yeah, I love it. So we need to start with an archetype. Now, just imagine your very perfect share chart, the one you want to marry. It's so beautiful. It has got everything that you want. It goes sideways up, sideways up, sideways up, sideways up, and it's got that beautiful primary trend. So just have a think about that for a moment, Reggie. Have you got that in your mind, that type of perfect chart? It's your
Like, do I have a perfect chart in mind that
Yeah,
I'm
can
thinking
can
of
you
right
picture
now?
it? Can you visualize it?
I can picture what you said, but if you
Yep.
had not said it though, Louise, I don't know what I would have pictured if you just said
Yes.
it.
Yes, yes, yes. So to know where we're aiming is so important. To find that ideal chart. You know, when when I was dating way back when, I had a checklist. I had a checklist of all of the qualities that I was looking for in my partner. And I have a friend who's a private eye, and my private eye friend used to interview these poor
Wow.
these poor men. And he would give
Really?
me an idea about, look, this one's probably not going to be the one for you. This one's okay, but he doesn't really speak too highly about his mother. So that could be a problem. So
That's a red
he,
flag.
yeah. So he helped me form my perfect archetype for my partner. I want you to do the same for your own trading, Reggie. You probably
Mm,
will end up with more than one perfect chart. To be open with you, I have three. I have got three beautiful
three.
charts. Yeah, yeah. So
Interesting.
I've got one that has that type of sideways up, sideways look. Some people call it Darvis boxes. Other people refer to it as a breakout. All right,
A
that's
breakout.
one. And
Okay.
then I've got another that's a retracement trade. So it's going up, but it's going up
Mm,
and then down and then up and then down. It's the actual classic definition of an uptrend, a series of higher lows, a series of higher highs. And I'm looking to get in at a time of temporary weakness. All right. So that's one
mhm.
of the things that I'm looking for. And then the other one that I use is if it's been trending for a very long time, usually we want to get in at first signal. And that means straight away after the breakout has occurred, after a base pattern has occurred, we want to hit it as soon as it breaks up above resistance. If you miss it, then how do you treat that trade? What you do is you wait until you'd be stopped out and then you can get back in again. That same pattern occurs. So it's actually a reset archetype. Now, you
For
want to
the third one's the reset
yeah, the
archetype.
third one's the
Okay, got
reset.
you.
Yeah. So you want to
Okay.
put some thought into this because from my perspective, this is the biggest difficulty with your plan. it
Mm,
isn't specific enough so that another trader can follow it.
absolutely not.
Yeah. Yeah, yeah. Well, that's why we're together today. So, it's great. If we've got to start somewhere as a trader, often we
For
don't
sure.
know what we don't know. And I'm trying to shine a light into your blind spot. So that's number one. Let's work on your entry. Okay. Now,
Okay.
exit is the next weakness. Now,
Serious weakness for me.
yeah, just perhaps give us an idea. So the trades that you're in, how do you decide to get out?
Usually if I've set a certain point that I have like an exit point, like let's say I wanted 20% upside and then it gets there, and then I'm out then. Or sometimes it just blasts off like it for no good reason. And you saw this happen a lot in the meme stock days where stocks were just shooting up for no good reason. And then I'm out of here at that point. Like once a stock is into the stratosphere for no good reason, I'm usually out of there at that point.
Okay. And is there any way that you've predetermined an exit, like if it goes up by this amount or if it goes down by that amount, or not quite?
The exit is the problem, that my biggest problem, because I don't really have a steady exit strategy. Whereas it's been with some stocks, it's been that a predetermined, I'm out at 20% or so. With other stocks, it's like a wave, Louise, and I'm just riding the wave, man. I'm just,
Yeah, I
I
hear
don't
you,
know
baby.
really when to get out of there, you know?
Yeah. Here are the unfortunate stats, and this is based on some very recent research and some older
Mm.
research. The stats are that over 75% of people lose money in the stock market.
Wow,
Now,
that's horrible.
it is, isn't it? Oh my goodness.
Hmm.
So we need to really be careful here. We have got a very big predator. The market is not out to help us. It is
No.
definitely not our friend. And unless we have every dot on top of every I, every T crossed perfectly, every component of our checklist completely completed before we go into the trade and as we get out, we could be one of those statistics, Reggie.
I don't want to be one of those.
No, no,
I do
no.
not.
And here's the good news is that the research also backs that you can learn how to do this. So there is a host of research, and if you're curious, I can email it to you. But basically, what it
Absolutely.
says, yeah, it's fascinating, is that if we improve our own mindset, because mindset is not innate, if we improve our own mindset, it has an impact on our profitability and our longevity as a trader. So, isn't that good to know?
Yes, yes, because from a new trader perspective, you're very much flying blind, and once you see some immediate success, I was very cognizant of not wanting to get too ahead of myself. Like, I'm not really getting too high, I don't get too low, so I didn't want to think like, well, I really got this thing down. I'm making all this money, I'm clearly rich, but I wasn't. And then more years came, and I came back down to earth a bit. And it's good to know that there's a better strategy that you can learn, especially if you've seen some success in the beginning and you don't want to get too ahead of yourself and feeling like you got this thing figured out.
So true. Actually, I think one of the most dangerous times when people come through my mentor program is if we release them into the wild in the middle of a bull run.
Oh,
Oh,
man.
yeah, that's
We're
almost,
geniuses.
yeah, they're geniuses. They believe their own press. And oh,
Yes,
wow,
absolutely.
in terms of resilience, we need some of those little knocks to be able to make us strong and to grow. So, this is one area I really want to focus on in your plan. So,
Okay.
there's two things that spring to mind. The first one is you are selling into an uptrend. That's right, is it? So when things go
Selling into an
crazy?
uptrend.
Yeah.
Yeah, when it depends on like how far. Are we talking about what my last statement I just made about when things go too
Yeah.
crazy and then I'm getting out of there? It depends on how far the uptrend is and what news there is to back that uptrend. If you're looking at no market, no new products for that particular company, no changes whatsoever, even they come out and say we don't know what's going on, and their stock is up 30-40% in a day, which is astronomical for me personally. That's just like an incredible amount. I'm usually scared of that. I'll usually sell because a lot of times I'm never looking for 30-40% overnight. So when it happens overnight, I'll sell and maybe look to get back in when it comes back. When it regresses to the mean, I'm usually looking maybe to get back in at that point.
All right, look, I don't mind your mindset there because, yes, if things do become manic, and that's where we have to define what is manic, then to sell out some of our position, I would suggest you change that to 1/3 of your position
A third.
because
Gotcha.
often what happens is the news is already factored in to that particular share. Now, I'll give you an example. I used to trade for this multi-millionaire. It was fantastic. He just gave me $15 million and said, go grow it. It was just divine. Yeah. And it was great 4 years of my life. But there was one particular stage. I had made a choice of a share. It was on my chart, on my screen. He came up behind me and he said, what are you doing? Really harshly. And I'm like, what? You know, he'd never spoken to me like that before. I was so shocked. And he said, have you been in my office? And I said, no. What's your problem? You know, starting to get a bit annoyed now. He said, look, you know, you are actually dealing with a share that I have an interest in and it hasn't hit the news yet. And then the next 2 days, it was all announced and the share did nothing because it was already factored in. There were enough people that knew about it, that told a neighbor, that told a friend, that told their sister, that already there had been a groundswell of support based on inside information. Often the market already knows that information. We think it doesn't. We think the journalist is breaking the news. Journalists don't break news. I know, I used to do that. We don't break the news. We tend to think that we've got cutting edge information because of the news, but it's actually not. So here's my thought, okay? If you do see that manic behavior, first of all, define how you are going to say it is manic behavior. So number one,
like the criteria to define what that manic behavior is. Gotcha.
Yeah. Once you've identified it, sell out 1/3 of your stock, not the whole lot, and leave the 2/3 remaining to be in that share because it could keep going. It could double, triple, quadruple. You want to have a look
which has happened for sure. It has definitely happened.
That's it. So you want to hedge your bets at that point. Removing a partial position is a great way to go.
Okay.
Yeah.
Noted here.
So that's one concept here that I wanted to talk to you about. And the other concept is to have a standard stop loss that is a trailing stop loss that runs along underneath that share chart. And when it gets down past a certain point, then you exit. So you follow that chart's trend up and it takes you to greater and greater riches. Now, I can tell you only 2, maybe 5 of my share positions are the ones that make my bank every single year. It's crazy. I wish it was more.
Really? That's interesting.
Yes, because in those ones, I have just piled in, I've pyramided, I've done everything I can to follow that share price up before I exit. So pyramiding is adding money to a winning position. All right, that's a fantastic strategy. Now, I have got one thing for you to research. It's called average true range. Have you heard of ATR before?
I have not. Average true range.
Average true range. Okay. Yeah. Now, I'll perhaps give you an idea how to use it because it is such a useful tool and I think you're going to love it so much. It's going to absolutely croquet mallet some specificity into your plan, which is what we want.
What I need. Much needed.
Yeah, completely specific terms in here. Now, average true range, and for those of you that are beginner traders, please let these terms wash over you. If you re-listen to this, it will make a lot more sense. You have to be prepared to be a little uncomfortable because some of this jargon is confusing. But what it is, ATR, it's a standard indicator in almost every single charting package. Now, it burst onto the scene in about the year 2000 when I started using it. It measures the volatility of that position. It looks at over the past X number of days or weeks, how much has that share gone up and down by? What's its usual behavior? Now, I'll give you an example. If you've got a $10 share. Let's do this because it's easy for me. $10
Okay.
share, and it's got an ATR of 10 cents. All right. It means it goes up or down by 10 cents when it's just behaving normally. Okay.
Interesting.
Yeah. So you want to know what normal looks like so that you
Right.
can
Defining what that
say,
normal is, right?
exactly, because then once it overextends in either direction, you have got non-normal behavior, shall we say.
Okay.
So what you do is you have a multiple of ATR. So let's use the $10 stock as an example. 10-cent ATR. If it goes down by 3 ATR, so 30 cents, then you've probably got non-normal behavior. If it
Now, is
goes,
this over a certain period of time, Louise? Are you looking at certain time periods for this?
yes. So the ATR, most people use a 15 or a 21. That's the most testing on that. So
15 or
it's,
21?
yeah. And in your charting package, you'll be able to see, usually just go with the default. Usually the default is the thing that most people use. And what you do, let's say you get it in at $10. If it drops by 30 cents, then it's $9.70, right? It goes to $9.69, then you're out, right? That's your initial stop. Now,
Okay.
let's imagine it's gone up by 30 cents, all right? You move your stop up to your entry point. And then it keeps going up, and you can keep on following that up with that 3 ATR stop. It's almost like it gives you a definitive point that says, I am not behaving the way you thought I would behave. So once it doesn't behave in that right way in your mindset, because it's not normal anymore, that's when you exit. How do you feel
Okay.
about that, Reggie? Is that making
I
sense?
feel like it's making a lot of sense. It's adding some like specific rules, kind of like a specific set of guardrails, so to speak. Because right now I'm driving on a highway with no guardrails. I'm just driving that thing, man. And this helps to kind of put some guardrails in a situation, so I don't crash here.
That is it. That is just perfectly summed up. Yeah. And that's what holds me into some of those really big winners as well. So I want to give you hope as well. I know I've kind of smacked you down here, Reggie. But I want to also give you some hope because as that trend moves on, I actually widen out my stop. I want to give it a lot of room to move. So I might go from a 3 ATR to a 5 ATR stop as time goes on, because what that does is it gives that share wiggle room. Now, that concept of allowing it, having that kind of ability to hold on when it's dropping, but not past that certain point, that is the skill set to master here. You will feel uncomfortable when that share turns over and starts to drop, but you will feel comforted because you'll know if it gets past this point, that line that you've drawn in the sand, if it goes past that point, you are out of there.
Right. And that's what I need to do.
Yeah,
I
you
need to
do.
master getting out of there.
Yeah. Yeah. And you can do it. It's so funny over time. Like you might fall in love with a share or two, like I have. I mean, my
Yes,
God.
absolutely. It's already
You just,
happened.
yeah.
It's happened already.
Welcome to the club. I think sometimes when we get that endorphin rush because it's treated us well, it is almost primal. We think we have to bond with that thing and that we are going to be together forever. But no, no, no. We really need to be detached and we need to be ruthless when it comes down to selling. Because if that isn't going to behave the way you thought, you need to dump it.
That's like a partner. If they're not behaving the way you thought, you need to dump it. So that'll
That's
do that for my
it.
stocks there.
It really is. I do think of it in that way. And I also think of it almost like children. Like, I mean, I only have two, but if I had 15 children, okay, and I had that little rat bag that was just being a pain, then I would really try and get that kid away from the well-behaved children because the well-behaved children may catch that through emotional contagion and ransack the house. So I want to
Absolutely.
ditch those little mongrels and get them out so that they can't play with the other shares that I have in my portfolio in case my discipline drops.
Interesting. Interesting.
Yeah, yeah. So how's all this sitting with you? How are we going here?
Good. I'm getting a lot of good notes here. I'm getting
Good.
it's really helping solidify some of the things I've thought about before, but not really didn't really have any way of going about it. You know what I
Yeah,
mean? So this is kind of helping give me somewhat of a roadmap here, to some
yeah.
a specific plan, so to
I'm
speak.
so glad. I'm so glad. And look, one of the other areas that I think we need to focus on as well is position sizing.
Okay.
Now, I'll give you an example. When I was in this little share called Futurus, right? I had piled in, I had a pretty big position in it. As a share, though, I never went past 25% of my overall equity because
Mm-hmm.
that's called the Kelly principle. All right. So you never
Kelly
want to
principle.
have, yeah, you never want to
Okay.
have more than 25% of your money in one particular position
Yes.
because of this. So futurists, hey, yeah, you and me, we're going to dance in the moonlight. It's so pretty. It's going up and I'm happy. And every day, I'd count the money I'd made, all the wrong things. So falling in love with that share and then counting my dollars before they were actually in my bank account. Yeah,
Yes.
never good. This thing dropped. It dropped with a big gap. All right. So there was no way I could get out of it.
Mm,
The stop I triggered because, yes, it had gone way past my stop loss. I had to get out. The only thing that saved me from having a huge dent in my equity was the fact that I'd capped my position size. If I had have had
mm.
90% of my money in it because I believed in it and it had
Right.
treated me well, then it would have really seriously damaged my financial future. Position sizing is so important.
Mm. So my
Yeah.
uh typically when I'm going into a position, if I have 10% into a position, that's kind of high for me. I try to stay around 5%. And if I really like the company, maybe it gets to 10, but even seeing double digits gets me stressed. I don't even want to see 10 a lot of times, 10% in one position. Um, but I've done it. I've done it before in the past. It's just not my usual. Usually I'm 5 to 10. So where do you recommend? Is there a minimal position there? Am I
Look,
being too low at 5%?
okay, so here's the thing. You're wanting a specific rule around something that I don't know the volatility of. I have
Mm,
got an exact method that you can copy, an exact method.
awesome.
It will tell you exactly how much to place into each position. All right,
Okay,
so I'm going to put this into the show notes because this is really important. If you are not using the correct position sizing, it will really hurt you. First and foremost, we know not more than 25%. Okay, we're starting with that.
for sure. Not more than 25%. Got you.
What you work out is, first of all, how much money do you have to invest in the markets? So, what is your trading bank, your equity? All right.
Got you.
Then, step
Hmm.
two, when you're starting, what you're doing is fine. Okay. You are using a fixed position size. It's okay because you're learning. But now you're really ready to start moving ahead. It's been two and a bit years since you started.
Hmm.
Let's
For
add some
sure.
more science behind what you're doing. So, what you'll do is you'll work out how much money you're prepared to lose in each position. Now, I know you've said in your plan 3 to 5% is your risk level. I have to get
Hmm.
that down because I can tell you 0.5% risk outperforms 1%. All right. So,
Really
yeah,
interesting. Interesting.
especially for positions that you're going to pyramid into, because you're going to let them
Okay.
have a bit of a chance to move, then you're going to add money to it. So if you've got 3 to 5%, your risk of ruin is so much higher. So much higher. You are putting yourself in a very vulnerable position. So can I suggest, Reggie,
Absolutely.
1% risk. So let's just
1%. Got you.
say, okay, you've got a $100,000 portfolio. We're not talking specifics for you. Okay, Reggie, that's not
Hmm.
what I want, but let's go with it with an example. You've got a
Okay.
$100,000 portfolio. If you've got something about that and you risk 1%, you're prepared to lose, you're risking $1,000 per position. Okay. If you
Hmm.
can risk 0.5%, depending on the size of your portfolio that you want to build, 0.5% will outperform 1%. It's really important that you actually risk a small amount. Then your next step is you look at the chart and you find the place you're going to exit. I suggest along the support line, or you use that 3 ATR. Okay, so that ties it into the personality of that share. Now, I've got a wee little calculation for you. Just roll with me. It'll be in the show notes. I'm going to send it to you directly, Reggie, because it is pure gold. If you're non-mathematical, don't turn off now, because it is easy to do. I swear to you, I promise you, maths does not come easily to me. I've got these figures in the spreadsheet. I put in the average true range, and out the end comes how much I can buy. You take your current price and you minus your stop price, and that's your risk. You're prepared to lose, for example, 30 cents using that earlier example. So that was your 3 ATR. You look at the total loss in dollars. So if you're going to use the 1%, it'd be $1,000. And you divide that by the risk. That gives you the number of shares you can purchase. And then you say the number of shares times the share price, and that's your total investment. Now, this is gold, because you're tying your stop into your position sizing and your risk. It's a beautiful little package to tell you exactly how many shares to buy.
Interesting.
Yeah.
It's very interesting.
Yeah, so I really do want you to consider that. It's very scientifically backed in terms of, okay, now we've got a cohesive tool. You can fill that part of your trading plan in with comfort, because you're going to say your initial stop is share price minus 3 ATR.
Right.
Okay, now, have I just blown your head off? Give me an idea of your temperature here. Are you still breathing?
I am still breathing. I'm here. I am ready to go. I'm very excited. Still excited, Louise.
You are a superstar. That is fantastic. Now, they are the key things. Now, I've got some other things that I want to mention to you, and I'm going to do them quickly because otherwise the show will be too long. And I do have some extra resources for you to research at the end. First of all, think about, when are you going to trade and when are you going to decide not to trade? You need a macro filter to tell you when to get into the market and when not. So for your market, Reggie, you're going to probably use the S&P 500. The Australians, we're going to use either the All Ords or the ASX 200. We're going to smack a 30-week moving average over it. And
30-week moving average.
When the index prices or points or pips, as they may be, are above that moving average, your macro is on and you're allowed to buy shares. When it's
above that 30-week moving average.
Yeah.
I got you. Okay.
And when the index is going down, don't buy. What are we doing buying? What in the heck? Yeah. I have bought so many shares when I was starting because I believed in that share. But no, that's not the right thing to do. The share doesn't even know you're alive.
The share doesn't really know you. Absolutely.
It doesn't know you. So work out when to trade and when not to trade, and put that into your trading plan. And also have a think about portfolio heat. And this is going to be one of the last things I'm going to cover with you, because I'm trying to save you from hurting yourself. Right now you're running with scissors, my friend. The odds are not
full speed. Absolutely.
Yeah. I say it with love, but you know, at your core, it's true. So you need to have a think about portfolio heat. Now, let's say you're going to go with that 1% position sizing. Okay. So for each share, you're going to risk 1% of your money. You don't want to open up more than 5 positions straight away. That's 5% portfolio heat. Now, this saves you, because let's just say you're a new trader, you get in, the market dumps and it annihilates you because you have just not thought of your overall risk. You've only thought of your risk per share. It's not a healthy way to be. You have to think in big terms. If every one of your stops get hit, what does that mean to you? And I can tell you now, you can recover from a 5% overall loss. You know
For
you
sure.
can. You can probably
Mhm.
recover from a 10% loss, but don't go up to 10% portfolio heat. What are we doing? No, we have to have limits. We have to know what we're doing, and we have to think of the worst case scenario. So that's your worst case scenario when you've got a 5% portfolio heat. It means you're likely, if everything turns to mud, you're only going to lose your 5% of your equity. Can you see how I'm trying to protect you here?
And is that in a particular position? So we're talking about 5%. Is that in a particular position, or is that
In
overall my
five
one?
positions. So you'll have
Okay,
1%
got
in
you,
each
got you,
position,
got you,
but
got
you'll
you.
only have 5 new fresh ones that are
Okay,
in danger of hitting their initial stop loss.
okay.
Now, let's project into the future, and the market hasn't dumped, and hey, good for you. Things are going well. You've been able to move your stop up to break even, and hey, even trailing stop for some of them. You're feeling good because you've lost that risk out of your key area there. Once that share has gone up past break even, you don't make a loss on that share. Your risk for that share is over. You've freed up 1% of portfolio heat. So let's say out of your 5, all right, you've got your 5 positions in the market. You've done what I said, 1% risk in each position, which has governed your position size.
Right.
One of them has gone up, all right, it's up past your break even point. You move your stop up to break even, bang, you've got ability to open up one more position because you've
Awesome.
freed up that portfolio heat.
All right.
So what this lets you
5%.
do, just in the overall perspective of things, you're protected. You are protected, firstly, because the Kelly principle says not too much of your money in any one position. You're protected because you're not balancing your risk on what you think. All right, this is scientific, that you're going to put a maximum of 1% risk. All right, so you're going to potentially lose $1,000 out of your $100,000. You're going to put 1% risk to calculate your position sizing in any one position. And then you're going to look at that overall risk, add up all of those 1% and realize, hey, you're at your 5% maximum. You don't open any new positions until one of those has gone past the break-even point.
Okay.
Now, have I blown your head off here? How are we going?
Yeah, it is very amazing. I'm very excited to
Oh,
put this into
good.
action.
That's good. Now, Reggie, you fixed that up in your plan. You're going to be ahead of 95% of traders out there. Firstly, you're already
Wow,
ahead because you decided to commit your plan to paper.
for
So few
sure.
people do. I want to give you a lot of encouragement that you're firstly incredibly brave and courageous. I mean, I have ripped you a new one here. There's no doubt. I have told you
I
that
do
your
it so nobody
baby.
else has to do it. I was like, let me offer myself up for the people of the world here.
Do you know what? I am so loving that attitude. And that is a beautiful thing because you don't have an ego. You don't have that inflated version of yourself that has to be perfect. And
For
that's
sure.
what's going to take you a very long way in the markets, my friend.
Awesome. Awesome. I very much appreciate that. It's amazing. Thank you.
Now, Reggie, have you got any questions that I can answer that will help you with this next phase of your life?
I I figured as you give me way more answers than I've ever thought I was going to get. So I didn't expect this many answers. I have like pages of notes. I do shows a lot. I don't usually ever have this many notes. So I have quite a bit of notes here. I got to get it all down. I'm going to put it into action, and then I'll circle back with any questioning after that.
You know what? I love that. And the fact that you're an action taker, you're willing to put yourself in harm's way for your own good. Oh, well done, my friend. Well done. Now, if you have been listening to this show on Talking Trading, just know that you can also watch the video to see Reggie's live reactions as I tell him what he needs to do on our YouTube channel. So come to youtube.com/trading game to watch Reggie's reactions. You've got a very beautifully expressive face, my friend. And thank you so
Thank you.
much for playing along. I've really enjoyed it. And the thing that I love with this is that I think I caught you just at the right moment because not only are you taking action, you're receptive to new information. And instead of saying to yourself, oh, yeah, I know that, you said, tell me more. And that is
absolutely
priceless with attitude. So I really just have to commend you, Reggie. Thank you so much for being on the show.
Thank you. Thank you for having me. I very much appreciate this.
Wonderful. So everybody listening, join us next week for another Talking Trading show. It won't be a live trading plan review, but I know that you're going to get a lot out of what I've got coming up for you. There are some amazing people that are just around the corner that I'm able to interview and bring you their knowledge, as well as sharing my own knowledge with you as a best-selling author of books on the share market. So during the week, trade well, trade with objectivity, and have fun out there too. Bye for now.